Have you ever wondered how the banking system in the USA came to be? It's a fascinating tale that begins in the late 18th century with the establishment of the first Bank of the United States in 1791. The birth of this institution was a result of a pressing need to manage the country's debt following the American Revolution. With its 20-year charter, the first Bank of the United States was entrusted with the responsibility of issuing a stable national currency and managing government finances. However, the journey of banking in the USA was anything but smooth. The first bank's charter expired in 1811 and wasn't renewed due to political opposition. The country then went without a central bank for several years, which eventually led to an economic crisis known as the Panic of 1819. This crisis highlighted the need for a stable banking system, leading to the establishment of the Second Bank of the United States in 1816. However, this institution also faced significant opposition, and its charter wasn't renewed, leading to the free banking era, a period characterized by minimal federal control over banking. Fast forward to the early 20th century, and we arrive at a significant turning point in the history of American banking, the creation of the Federal Reserve in 1913. Born out of the need to prevent financial crises and maintain the stability of the country's monetary system, the Federal Reserve was designed to serve as the nation's central bank. The Federal Reserve's creation marked a new era in American banking, transforming the way the country's banking system operated. This institution was given the power to control the money supply, regulate banks, and act as a lender of last resort. It was also entrusted with the responsibility of ensuring the overall health and stability of the nation's economy. Through these historical milestones, we can see the evolution of American banking from a single institution handling the country's finances to a comprehensive system designed to manage economic stability. The struggles and triumphs of the past have shaped the banking system we know today. And so, the foundation of the modern banking system was laid. With the foundation in place, the banking system evolved, adapting to the changing times. As the 20th century dawned, the banking system began to undergo significant changes. The introduction of the Federal Reserve in 1913, for instance, greatly influenced the role and reach of banks across the nation. This central banking system provided a certain level of standardization, stability, and regulation that was previously lacking. But the real game changer came during the 1950s with the advent of credit cards. Initially, these cards were issued by individual stores for use only at their locations. However, in 1950, Diners Club launched the first universal credit card, marking the beginning of a revolution in personal finance. This innovation not only simplified transactions, but also introduced the concept of buying now and paying later, dramatically changing consumer behavior. Then came the 1980s, a decade recognized for its deregulation era. The Depository Institutions Deregulation and Monetary Control Act of 1980, for instance, removed many of the restrictions on banks, allowing them more freedom to compete and innovate. This led to an explosion of new financial products and services, including the proliferation of ATMs and the introduction of online banking. Indeed, these decades saw a banking metamorphosis, driven by a blend of technological advancements, economic demands, and regulatory changes. From the humble beginnings of goldsmiths storing gold and issuing paper receipts, to the creation of central banks and the birth of credit cards, the banking system had been continuously reshaped and refined. Yet, the evolution did not stop there. As the new millennium approached, the banking landscape was poised for another seismic shift. The digital revolution was on the horizon, promising to redefine the way we save, spend, and manage our money. The banking system had truly come of age, ready to face the challenges of a new century. As the 21st century dawned, so did the era of digital banking. This new age saw the rise of online and mobile banking, changing the way we interact with our finances. No longer were we tied to the physical constraints of a bank branch. From the comfort of our homes or even on the go, we could now access our accounts, transfer funds, pay bills, and apply for loans. This was all made possible by the relentless innovation in the field of financial technology or fintech. Fintech companies seized the opportunity to disrupt the traditional banking model, leveraging cutting-edge technologies like artificial intelligence and blockchain to create more efficient, customer-focused banking experiences. Mobile wallets, peer-to-peer payment platforms, robo-advisors for investing, these are just a few examples of how fintech has redefined what it means to bank in the 21st century. But this digital revolution was not without its challenges. The 2008